Welcome back to this next episode of Legacy Lessons with Jack and Chan, where our goal is to provide you education, inspiration, information over a little bit of conversation. So let's go. You know, one of the things when I used to come out here back in the 80s with my mom, don't tell anybody, she used to sneak me in some of those shows. She loved shows. And see, now I love shows. It's one of my favorite things to do when I'm in Vegas. So when you come to Vegas, do you ever go to the shows?
I do. I've seen some good stand-up comedy shows. I also enjoyed watching Cher. I also watched and enjoyed the Michael Jackson show.
That's right. You did go see
we
that
did that one together.
That's right. Oh my gosh. Amazing. Don't we just love Michael? Yeah. So going to shows is a big thing. Absolutely. It's so much fun. I think when I'm here, I'm going to go see The Awakening. Have you heard of that one? It's actually at the Wynn.
I have heard of it. And also, I've also enjoyed the Blue Man Group.
Oh, that's right. Now, that's actually a big show in Chicago where I come from, too. They actually have a residency in Chicago, so I'm very familiar with the Blue Man Group. So anyway, today I thought it would be fun for us to take some time and really break down some key concepts, because I want to just ensure that we're helping, again, to educate, inspire, provide information over this conversation. So guess what we're going to do today? We're going to talk about covering your assets. All right, so you know, it's interesting because what I was having a conversation with a dear friend recently, and they shared with me that they're hearing a lot about alternative investments out there. And that tends to be a topic of conversation, especially with, you know, the next generation of investors. They're hearing that term. And so really what I want to do in today's show is spend some time breaking down some of these key terms and concepts and definitions, because, again, a lot of investors out there may have heard these terms. They pretend like they know them. They don't really know them. So we're going to take some time and really, again, break that stuff down. So let's start with, honestly, what is an asset class? Let's start there.
Well, asset class will tell you that you're going to have different type of investment options out there. You can invest in fixed income, which is bonds or credit type of products. And those, of course, pay you a fixed amount. And, of course, they're worth less or more depending on whether the credit that you're basically investing on is good. If it's getting worse, then the value goes down. It's also a function of interest rates. And then, of course, you have equities, which is another class. And that one will basically allow you to participate in the growth of a company. And it also puts you a little bit lower in terms of getting your claim if something bad goes on. So the key in all these investments is to be diversified.
That's right.
To have a little bit of different classes in your portfolio, depending on which one is sort of more tailored to the amount of risk that you're taking.
Absolutely. And we're going to get into risk because, again, you know, I think that also is something that's very key when we're talking about investing. It's really about understanding your appetite for risk. And some people are way more conservative than they really need to be honest. They think that they just need to have everything sitting in cash, which is an asset class. You know, and some investors are like, they're on 10. They're ready to go all in, you know, and really, you know, take their money and have it, you know, participate in multiple asset classes in the capital markets. And so let's talk about alternative investments as an asset class. Help us understand, what is alternative investments?
Well, Jack, the term alternative really was born from the desire to diversify a little bit more. The real term of alternative really emanates from trying to find a different asset class that's not really correlated or directly correlated with the conventional type of investments that you make. Now, what can an alternative asset be? It could be farmland. It could be cryptocurrency. It could be commodities. There's so many different types of alternatives. It could be real estate. There's a lot of different assets that can go into the mix. But as in any other investment, again, that power of diversification is going to be important, because if you go into an alternative investment, but you make that alternative bucket 100% just one asset class, yes, you are diversifying, but not as much as you could be if even that bucket class was somewhat diversified.
That's right. That's right. No, I think I really appreciate you breaking that down and helping to demystify, if you will, the definition of alternative, because, some investors out there may have thought crypto was like just that, right? But like you mentioned, it could be commodities, it could be real estate, but it's really about saying these particular investments are not correlated with the traditional markets.
Right.
Okay. So just for our listeners, to keep it real simple, that's really what an alternative is.
Right. And some of these assets also are not as liquid as if you buy a stock and you're buying and selling it, the price doesn't change that much. You're buying a U.S. Treasury security, you can buy and sell it all day, and the price from minute to minute doesn't change that much. Obviously, over long periods of time, or if there's a major shock in the economy and interest rates change, you're going to have some shift. But in a minute to minute basis, they don't shift very much. These alternative investments not only have a little bit more risk, but they also are less liquid. So when you talk about alternatives, in many instances, alternative investments come in two forms. One, you can actually make them a little bit less liquid and not allow the investor to move money in and out. You can't sell it as readily. So they have lockup periods, which means, in simple terms, they may tell you, well, you can only redeem these shares maybe once every couple years. Some of them have once a quarter. Depends. And some of them make them instantaneously liquid, but those obviously are not going to give you the same high returns as something that's less liquid, because again, the person managing those funds has more flexibility if they're less liquid.
Got you. So it almost goes back to your original point of like, thinking about that risk appetite, right? If I'm in that sort of alternative that's not as liquid,
Right.
that I'm expecting greater alpha, greater return on my portfolio, I better also have an increased time horizon as well.
That's right.
Right. So these kind of investments are, would you say, for what type of investor? If I'm going into alternatives, am I am I a new investor? Am I a savvy investor? What type of person should be thinking about alternatives?
Well, obviously, the alternative investment that's going to generate a slightly higher return are the ones that are going to be less liquid. And if they're less liquid, that means that the investor that should be in those are investors that have a higher risk tolerance, but also have a much bigger portfolio, because they can afford to leave part of that portfolio untouched, and they're treated as less liquid. If you may need the money, or you may need more flexibility, or you may have less tolerance for risk, you want to have something a little bit more liquid. And again, the term alternative, by definition, is somewhat less liquid in that sense. But keep in mind that if you invest in an alternative investment that's liquid, you're not going to get the same rate of return as if you invested in an alternative that is less liquid.
Correct. No, this is good. And so, for our audience out there that's listening, the lesson here, right, is when we think about alternative investments in general, we want to have a bit of an appetite for risk. We want to know that our time frame should be a little bit longer so that we have the ability to be able to stay in those investments, since they tend to be illiquid. However, if we need that liquidity, we're going to be sacrificing some of that return. And again, we want to be thoughtful that perhaps that may or may not be the right asset class if we don't have a huge bucket of money or a huge appetite for risk.
That's right.
Very good. I love it. All right, let's talk about some other asset classes. So that's one, but the other one that always is getting a lot of buzz now is ESG. All right. So, lots of stuff about ESG, right? For those of my listeners that have never heard that term, right? Environment, social, and governance. All right. Social impact and governance. So what's your story on ESG, Dr. Chan?
Well, many studies out there do show that when you invest in these type of investments, you not only do good, but you also can get a higher rate of return if the person managing these funds is somewhat careful, diligent, and pays good attention to making sure that only the best assets get in. As you probably know, this topic has become very controversial. Some states get a little nervous when you talk about ESG. So it's sort of falling into less favor. But what I find is that you're still seeing a lot of investments that sort of conform to ESG, but they're not basically yelling about it. They're not getting on top of a soapbox and telling you that they're ESG. But if you go underneath the hood, you'll see that there is some ESG. But the truth of the matter is that in the last year or so, year and a half, we're seeing a little bit less focus on it. Similarly to the way you're seeing less talk about things like DEI.
Right, absolutely. And I know we're going to get into that subject for sure on one of our legacy lessons. But going back to ESG and going back to, as you mentioned, getting underneath the hood and really looking for those bad actors, right? Because the original goal with ESG was to say, let's look for the bad actors, let's get them out of these portfolios, and let's clean it up, and so that when we go back and represent this portfolio to a client, they can feel good that they're not only making profit, but they're doing it with purpose, right? It's that feel-good investment, right? And so, now that feel-good investment that you and I always felt good on, and we feel, it's like you said, it's out of favor, but they're still out there. It's not like they went away, like you said. They didn't go away. They're just not screaming it from the mountaintops anymore. Right. So, if you were to forecast this thing, I may be asking you to do something fun, but like if we were like looking out 3, 5, 7 years, are we still talking ESG?
Well, I think we will, and to some extent, and we'll be behaving as though we're talking about it. Because for years, when we talked about ESG, many people thought, that means we're not going to invest in energy companies because somehow they're not good for the environment and things like that. But what are we seeing today, JaQ? Today, we're seeing that many of these energy companies are becoming greener and greener. And so to say that you cannot invest in energy companies because of ESG requirements is false. Now, all of a sudden, many of these companies have evolved and they're doing the right thing. And so you're realizing that you can't exclude those type of companies. And I think that if you look at many studies out there that show that if companies have good governance, they treat their stakeholders well, and they treat their employees, they have good management practices, guess what? They also tend to perform a little bit better. It's just that the terms in itself is sort of getting out of favor, but the things that are happening behind the scenes, those are still performing quite well.
Interesting. No, this is going to be a really, a story that we're going to be following for a long time, especially, again, with the next generation. I'm thinking about the people that will be inheriting the wealth, this great wealth transfer, and that generation literally screams ESG, so that's why we're going to be following this for a long time. The other topic I want to get into before we jump into some inspiration is AI, and really that topic of technology as an asset class. So let's talk about technology and knowing what we know now about all the conversations with AI, the fact that, 30-40% of jobs globally may be impacted over the next 10, 20 years, with all the advancements, GPT and all this stuff that's making our lives easier or worse. I don't know how to put it, right? But I would like, our audience to understand first, what is technology as an asset class? And then let's double click into AI and your thoughts about that.
Well, technology is an asset class that allows businesses, and it also allows different consumers to basically make things a lot more efficiently.
Yeah.
And so AI, believe it or not, it's sort of like something that will enhance productivity, but it's more or less on steroids relative to the type of technology that we knew before.
Right.
When I was much younger and other people were much younger, we saw that technology was taking over. We used to have huge pools of people typing. And so new technology came out, the personal computer, and people didn't use the computer anymore. And people thought, this technology is going to destroy jobs. I recently wrote a Substack article on this topic of AI and the impact on productivity. And one of the things I find is that if you go historically, every time you have a new technology, it actually ends up creating even more jobs. Because it really gives birth to new opportunities.
Sure.
When I was going to college, to give you a good example, I remember that the college I was going to had an elevator person moving you up and down, and they went on strike when they were trying to develop these new elevators that basically didn't have an elevator man or an elevator woman to bring you up and down. They went on strike. And yet, guess what happened? A lot of these individuals ended up getting jobs in other places. And so I actually ended up tracing a lot of the different industries that have generated increase in technology. And at the end of the day, we end up creating more jobs. So the study that I did finds that even though AI may displace 30 or 40% of the existing jobs, it'll generate a lot more jobs in the future. For example, when you and I were growing up, there was a lot of things that people did on their own. They would go in the backyard and fix their car. Today, of course, you don't do that. It's a lot more mechanized or automated, and you don't need people to fix their own. But guess what happens? Now, all of a sudden, you don't fix your car, so you do other things.
That's right.
You hire people to take care of your lawn. You customize your car. Parents are hiring basketball coaches, golf coaches. Even adults are hiring career coaches. All of those jobs were nowhere to be found in the old days.
That's right.
So we are seeing more and more jobs being created. So even though things like the personal computer, people thought it was going to destroy jobs, it ended up creating more jobs. Today with AI, people are very nervous, but now you're going to need to hire people that will be able to manage these massive amounts of data. How much data or what kind of data do you put into these large language models that basically train a computer to basically do things that humans were doing before? Right. So you now have to basically employ a whole new different type of job, different people to do these kind of jobs. So at the end of the day, almost no technology has actually ended up displacing. If you really push me far back, you go back to the beginning, more than when the United States first began, 80% of all the jobs were in the farm. And so when you decided to bring all these tractors, people said, well, 80% of all the jobs will disappear. And today, guess what? Less than 5% of all the people that we employ in this country are working in farms.
That's right.
Does that mean that we have a 95% unemployment rate? No, we actually have the lowest unemployment rate in 50 years.
Wow.
And that's because we created a lot more jobs, and they're different.
Yes.
That's exactly what's going to happen with AI. Are they going to be the same jobs that we have today? Absolutely not. But they will be different. And if you look back, when these technologies started, when Facebook started, when TikTok, all these different social things, look at all the jobs that those
That's right.
technologies created that never existed before.
That's true.
That's what's going to happen.
That's true. No, you just got my head spinning with just like you said, it just totally makes sense. I mean, to your point, it's like this evolution. I remember being a teller in the 90s, and like you said, I mean, it was probably 25 tellers on the teller line back then. Now there are no tellers, right? Everything. But what let me tell you what happened though. All we did back then was transactions. We weren't building relationships. We were literally just servicing clients by cashing their check. And that's how we were making money. Now, fast forward to 2024, you don't have 25 tellers on the teller line, but you have people inside, say, those locations that are able to now slow down with those clients, really build relationships, and uncover maybe opportunities to help in a much deeper, more meaningful way versus just trying to, get them through the line. Next. And so it created, like you said, a different type of role inside of those institutions. I saw that, we both saw that for ourselves. And I think much more value, which is why, those businesses are still booming. And like you said, we're not seeing the unemployment in those areas decrease. We're actually seeing it get better with technology helping to support, I like to say, a high-touch, high-tech sort of experience, right? So we are back with a moment of inspiration. And I was just thinking about this topic of covering your assets. And when I think about assets, of course, I actually break it down in an acronym form for myself. And I think about what it means more so as someone who's accountable to my purpose as an investor and as a leader in this industry. So A stands for accountability. All right. And if I'm going to be an investor and if I'm going to truly set up my family for multi-generational success, then I need to be accountable to my plan. All right. So that's A. And then I look at S. The first S is strategic, right? I can't just think about today. We talked about that in one of our episodes about that FOMO, right? That fear of missing out. And albeit I know these last few years have been tough on so many people and we've, seen a lot happen, we have to still be strategic. We've got to be thinking in the next generation, what's happening with my children, my children's children. And so to me, an asset, or someone who considers himself an asset is strategic. So the third S stands for smart. And essentially what I mean by that is almost like having high IQ, right? Being able to study, being able to take, seriously the fact that, one, we only have this one beautiful life to live. And so yes, let's live it and live it up. But at the same time, it is very, very important that we take the time to understand our health and our wealth. And those are two very important topics. So we talked about accountable. We talked about being strategic. We talked about being smart. But the E in asset stands for EQ. So you can be smart, right? But if you don't have great emotional intelligence, then the first three letters of cover your assets is then what you end up becoming known as, right? And so, for me, it's really about, having, that strong emotional intelligence that is much sometimes greater. That's where you're able to really tap in and serve to your greatest potential. And that last letter in asset is T, and that stands for talent. And to me, when I think about talent, I think about my purpose. And I think about what it means to have purpose, because if I'm able to operate in my purpose, then to me, that's where real wealth is found. It's the ability to wake up every single day knowing I'm doing exactly what I'm supposed to do. So my inspirational moment today, I want to share with my friends, asset, my friends, accountable, strategic, smart, emotionally intelligent, and talented. And if you do that, you're going to be an asset. What you think?
I say go for it.
All right. All right. So let's get back, and we're going to wrap up today and just share a little bit more about our topic. We've been talking to our friends today about covering your assets and really introducing the topic of what is an asset class. And we've covered several asset classes today, from alternatives to ESG to technology, AI. And so, Dr. Chan, you've gone all over the world. You've seen, I'm sure, various, different asset classes perform in great environments, depending on where you are in the world or depending on what time of year it is. And I'm sure you've seen things not perform so well, depending on what time of year it might be, what's happening in the world right now. So share a little bit about that. Again, when we think about asset classes, and globally, there's tons of things that we can consider. There's international investments. There's just different things that are out there. So talk to us about that.
Well, when people think about different asset classes, the first thing that comes to my mind is, should we invest in growth stocks or should we invest in value stocks? And historically, when the economy gets into for the sake of a better word, into a pickle, or things are not going so well and the economy is challenged, guess what? Which companies are likely to be able to have more resilience? They're going to be the growth stocks.
Yeah.
And that's why in those kinds of environments, growth stocks tend to do a little bit better because they're viewed as being more resilient.
Yes.
But at the same time, because growth stocks are associated with returns into the future, if you have super high interest rates, that also challenges them. So you have to balance in your head. And certainly when you're making these investments, we know that high interest rates are sort of a headwind for growth stocks. Mm-hmm. But at the same time, if they have a propelling enthusiasm and a compelling reason to invest in those stocks, then they're going to do a little bit better.
Yeah.
For example, you saw that during this period when the Federal Reserve raised interest rates very quickly by more than 500 basis points. Guess what? The Magnificent Eight performed well. And the reason for that is because the perception was that because they have this great new idea of artificial intelligence, the growth and the profitability in the future was going to be so great, Jack, that it was going to offset the pressures of higher interest rates.
Interesting.
And then the question is, should we ever invest in small stocks? And why do we invest them at all? And one of the reasons for them is if you all of a sudden think that something bad is going to happen around the world, these large cap stocks generally have more exposure to things happening all over the world.
I see.
And so if the U.S. economy is doing well, but all over the world is doing badly, then you're going to want to have companies that have greater exposure to the U.S. And typically small and mid-cap stocks have more exposure to U.S. than the large cap stocks that have more exposure overseas. So there's always different compelling reasons as to which asset class you should invest in. And then another final point is that small cap stocks don't have as many analysts following them. So if you somehow can do a lot of homework on these small cap stocks, or for some reason you have good intel on a small cap stock, you may be able to capture some sort of profit out of these stocks because you're not heavily covered like the large cap stocks that have a lot of analysts covering them. So therefore, the opportunity to find something that nobody else knows is much lower in a large cap stock than there is in one of these small cap stocks. So there are many different factors, and all these things will have to be taken into account, which is, by the way, Jack, the reason why doing all this by yourself is not always optimal, because the average person, they have a life.
That's right.
Why not at least consider hiring a wealth manager, someone that manages these funds that actually spends all their time worrying about these things and specializing in these different areas?
Absolutely. I mean, what you just said, that can be very complicated for just the everyday investor, and although you made it super easy for me to understand, and hopefully for our listeners to understand, it takes a lot of work and a lot of energy to, like you said, you brought up some very interesting points around, large companies maybe having that global exposure. So albeit even if we're doing really well here in the United States, if there are some things happening catastrophic elsewhere, that could still be an impact, where some of the more medium-sized and smaller companies don't have some of that international exposure. So then they tend to be shielded or protected from some of those maybe international events. And so those are things, and you mentioned growth, companies versus maybe value companies that are out there that are more so focused on, going in and at a value, I like it that the word in itself, versus growth is really going after those companies that are focused on hyper growth, right? And so for our listeners that have heard those terms, value versus growth versus blend, right? It tends to be, where, those companies are focused on those areas. And so I love that you brought that point up. And so as we wrap up this conversation about asset classes, we covered a lot, right? We covered, definitely some various sectors, various sizes. What else should our listeners be thinking about? I mean, are there any new asset classes outside of alternatives and ESG? Are there any other ones out there that we should have our antennas up on?
Well, sometimes people also want to track and even to make investments in foreign currencies.
Okay.
But again, it all comes down to your portfolio, because if all of a sudden the dollar is very, very strong, that means that all of a sudden, if you have a large cap company selling products overseas, the dollar is very strong, which means that their currency is very weak. In order to buy those products of the country that has the strong currency, it means they have to use a lot more of their currency.
Okay.
And guess what? They may not want to do that. They may want to buy from another country or even a domestic product. So when you are formulating these portfolios, you not only have to think about economic growth between the different countries, but you also even have to take into account foreign currencies. And some people may want to make that another asset class to invest in currencies all over the world and betting whether your currency is going to be stronger or weaker, and you can make that as an alternative asset class to actually have some exposure to currency. But currency can actually end up having an impact on your portfolio.
Yeah, no, I'm that's a whole nother conversation with, especially with everything that's going on around the, conversations of currency in Brazil, Russia. We've been hearing those conversations. So thank you for bringing that up as, not only an asset class, but a risk, that we need to be considering when we're thinking about portfolios, especially when we have international exposure. And many of us, when we're investing in our 401ks, we may have, a position internationally, and that, is something to consider, right? It's that currency risk. Excellent. So as we wrap up today's conversation around asset classes, I'm very, very, very grateful that, you were here with me today to really help break down some of these key terms like alternatives, ESG, technology, large, medium, small, so much more conversation about this. But hopefully our listeners today walked away with just a little bit more education around the importance of understanding what is an asset class, because when you're investing, that's what you're investing in, right? You're investing in different asset classes. But then now you can really determine, based on that appetite that we talked about for risk, what might make the most sense, for you and for your individual situation. So like Dr. Chan said, the best thing you can do, don't try to figure this out on your own. Please seek the advice of a professional who can sit down with you, really understand your situation, both where you are today and where you want to be, and help construct a portfolio that makes sense. So with that being said, we're going to wrap up today's Legacy Lessons with JaQ and Chen. Until next time, my friends, we thank you so much for joining us. Again, our goal is to bring you here to make sure that we bring you education, information, inspiration, or a little bit of conversation. So until then, God bless.